Hello and welcome to this free webinar with ERE Property on property due diligence. My name is Sophie Lane and I am the Acquisitions and Communications Executive at ERE Property, and a very large part of my role is to do property due diligence. Now, for the company that we have, this is extremely important, but I do also believe that it's really important for investors to also do their own property due diligence. Hence why I've decided to put on this property due diligence webinar. So I just really hope that it's going to be informative for you, educational, and you will get something from it. So what I will be covering is kind of a few main topics. So first off, what is property due diligence and why is it important? And then also going on to the four main things you need to be looking out for. Now, property due diligence in itself is a bit of a beast, but I do believe that there are four main topics that are really important to understand. And as we do just have a short webinar here, I am just going to be covering those four topics. Hopefully I will go into enough detail for you to be able to take something away and put that into practice, however. So just to make a note that this webinar is going to be predominantly based on apartments. So apartments do come with some additional due diligence to them, but most of the stuff that we're covering does also apply to houses. It's just, like I said, apartment has a few more stages to it. So I'm going to go ahead and share my screen now. So hopefully you can all see that okay. Okie dokie. So as I said, welcome. So first off, what is property due diligence? So property due diligence is basically doing everything that you can do to evaluate the property that you're looking to invest in before you buy it. So property is a big investment. You put down a relatively large sum in terms of an exchange and deposit amount, and you really want to be understanding the risks and the rewards to doing so. And thorough due diligence is going to inform you of this. So why is property due diligence important? So all investors, they may have a different strategy. It might be that they are investing short term or long term. It might be that they're investing in off-plan properties or already built properties. Or they could be investing predominantly for cash flow or capital growth, or a combination of the two. But the one thing that is common for all property investors is that we all want to be making a return on our money. And that is what we're getting into investment for. And due diligence is so important to ensure that we're doing that wisely and the most safe we can do. So what do you need to look out for? As I mentioned, I'm going to be covering four main topics here. And I am going to be covering them in order of due diligence. So like I said, although I'm not covering them all, I will be covering a large part of what you need to know. And the order of them will come as you're meant to be doing them. So if it doesn't pass the first stage, then you won't go on to the second stage. If it doesn't then pass the second stage, you won't go on to the third stage. So this is how you should really be carrying out your due diligence in its order. So location is one of the main parts. So when looking at a property investment, you want to be aware of three main things about the location. So what is your tenant demographic? What's the likeliness for good capital growth? And what's the other competition in the area like? So to figure out your tenant demographic, you want to be looking at major employers in the area, the job opportunities around, and whether it's a commuter or city area. You could also look whether there's universities close by, and looking at these will help you determine who your tenant is going to be. For example, if it was close to university, it might be more of a student tenant. If you were in a commuter town rather than a city, it might be that you're targeting someone who's able to pay a bit more of a lower rent and is going to be commuting into the city. So there's a market for all of these tenants. You just want to understand when investing what kind of tenant you are looking for. So second, what's the likeliness for good capital growth? So to determine this, you want to be looking at regeneration plans. So you can find these on most council websites. Birmingham actually released their 20-year plan most recently, which was really interesting. We shared on our socials. And in terms of the regeneration plans, you want to be looking at, are there any improved transport links? Are there new employers coming to the area? Are there any new shopping or entertainment centres being built? Basically anything that's going to make the area a more desirable area, increasing the demand for people want to move and live in the area. And that is going to increase the capital growth and the value of your property. Another thing to note is also if other developments are popping up in the area. So we actually have a development in Slough, and when we took on the development, it didn't seem like there were a lot of apartments going up. But now we've noticed quite a lot of our competitors are also selling in Slough. So when other people are building, it does give you confidence that they have also done their research and they wouldn't really be investing and promoting a development in an area that they didn't think was going to do well. So I'll just give you an example of a commuter town that we are selling at the moment. So we are selling in West Bromwich. That is only 14 minutes outside of Birmingham, but the prices are half of Birmingham. West Brom itself actually has a really good town. It has a shopping centre, a cinema, a big JD gym, and it is very well connected to Birmingham. Now, due to coronavirus and also just trends that we're seeing, commuter cities are really increasing in popularity. Like I said, for investors, it's really good because the property prices are half that of Birmingham. And it does mean that the yields are a lot higher. And because it is only 40 minutes away, it's not in the middle of nowhere. People are going to want to live there, and it does have the amenities that people would also want to live there. So I thought I'd just kind of cover that as a real life example for you. So then going on to number 3, in terms of location, what is the competition like in the area? So it could be that the area is over or undersupplied, and this can be a disadvantage or an advantage. So if it's undersupplied, it could be an advantage because if there's no other competition in the area and the demand is there, then people are most likely going to be coming and renting your property, which means the chances for voids are going to be lower and your occupancy rate is going to be much higher, which is obviously very good for you as an investor. The disadvantage is that why is there an undersupply? Is it because there is no demand in the area that there's nothing, no properties in the area to rent? So you just need to do your research in the first 2 points I mentioned just now for location, and that should give you a good idea if those regeneration plans are happening and if there is a demand in the area. So if there's an oversupply of property in the area, like I said, this could be a disadvantage or an advantage. So a disadvantage is that if there's more competition in the area, there's more choice, which might mean that the rental prices could be driven down. You could get a lower rental amount as more competition comes into the area. But what I would say is if you choose your investment wisely and your facilities are really good, the location is key, then this shouldn't really be too much of a worry to you. So once you've established that you've got a good area and you want to invest in this area, then you should be looking at the numbers. So there are 4 main areas to analyse for the numbers. So the first one is the property purchase price. So how do you know whether what you're paying for your property is above or under what it should be? what you need to be doing is looking at comparables within around a 1 mile radius of the postcode that you're looking at. So these comparables do need to be like for like. And what I mean by this is you need to be looking at properties that have the same number of bedrooms, a similar size square foot, similar spec, and similar facilities. Also, obviously, similar location. And also what you need to be making sure is that if you're looking at a property that, for example, does have a gym, it has a 24-hour concierge, it's just been done, it was an off-plan property and it's just been completed, and then you look at another property and it's got no facilities, no concierge, it's quite old, but this is 10 grand cheaper than the property you're looking at. So when you're looking at these two properties, they're not like for like, and this £10,000 difference is probably going to be warranted. And it doesn't mean that you are overpaying for your property, because like I said, the facilities aren't the same. You're not getting a similar product for that price. So when looking at comparables, you really need to make sure of this. I did mention to look in a 1 mile radius, but actually when you're looking in cities, because it is more heavily populated and there is more developments within a closer range, I would recommend around a 1/4 mile or 1/2 mile for a city to get a true comparable. So how do you do comparables? So you can go onto Rightmove, you put in the postcode that you're looking at, you set your radius to up to 1 mile, and then you press search. Then it will bring up all of the properties that you're looking at, and you can have a look at them, compare them, write them down, and see whether the property that you're looking at is favourable in terms of prices. Now, at ERE Property, we do have a subscription to Rightmove, and we can pull some comprehensive reports. And this is part of our due diligence process. We pull off these comprehensive reports before we look at any developments, and before we bring them to you. And these will be available for you to access also. If you did have a specific area that you wanted to have a look at, I would be really happy to help you. I can have a look and pull a report for you and send it over to you. That's no problem whatsoever. So then you want to be looking at how much rent can your property achieve. So this is similar to the property purchase price. You want to be looking at comparables in the area. So instead of the price of the property, you want to be looking at the rent of the property, how much are these properties renting for. And this will help you work out your gross yield, which I will come on to later. It's something that's important to property investors and people look at before investing in property. We also have a lettings business with ERE Property, ERE Lettings. And so we obviously are on the ground, we're seeing in real time how much rent is being achieved. And we always consult our lettings director, Chris Stone, for how much the rents he thinks can be achieved. He's a really friendly guy. I'm sure, again, he can have a conversation with you, or send a quick email over, and he'll help you determine whether the rent being stated in your investment is something that can be achieved. Then you want to go into additional costs. As I mentioned, this webinar is predominantly on apartments, and with apartments, additional costs do come. So one of the costs is service charges. So service charges are worked out dependent on the square foot of your apartment usually, and the amount charged is dependent on the location and also the facilities on offer. Usually the more facilities, the higher the service charge. As these facilities are communal, they do need to be maintained, and someone does need to be paid to maintain them. So to give you an example of a rough price of service charge, at ERE Property, all of our developments range from around £1.50 per square foot to £2.60 per square foot. So we actually declined a development the other day purely based on the service charge. They were quoting £3.60 per square foot, and the location that they were along with the facilities on offer, it just didn't warrant the service charge. And service charge is an additional cost, and this will eat into profits. So we really want to be making sure that those service charges are in line with what they should be. When looking to invest, you can request a service charge breakdown. So for off-plan properties, it might just be a draft budget that the developer has, or for already built properties, it should definitely have a budget there that you can have a look at. And then you can see the allocation of the spend, where the money that you're paying is going, and just see that that is warranted. So another cost is ground rent. You might have seen in the news recently quite a bit about ground rent and the leaseholder reform. So the government has committed to any leases that are being renewed, that are going to be renewed at £0 for 990 years. The whole reason for this was basically freeholders who own the land where the development is built. Some of them were unfortunately exploiting leaseholders and increasing the ground rent pretty much yearly with no kind of reason for doing so, and they could get away with this as they owned the land. Now, at ERE Property, we only look at properties that have the thing in place that is 0.1% of the purchase price. That's how the ground rent is worked out, and reviewed RPI every 10 years. So what this means is that your ground rent will only ever go up with inflation. There won't be any costs that are accumulating and escalating for no reason. This is also important for mortgage companies. So mortgage companies won't lend on apartments if the ground rent is not set to this clause. So that is something that you do need to be looking out for when you're looking at investment opportunities. And then we go on to management fees. So at ERE, our management fee is 10% of the rent every month. Others are higher, and it does also depend on what type of let you are doing. So a long let, so where you have a tenancy, will be around this 10% or higher. But if you are doing a short let, for example, Airbnb or more corporate lets on a short-term basis, then this can be considerably higher. So I have seen kind of short let figures be around 18% management fee plus VAT, so it works around 22%. So yeah, you just need to check on the management fees, because again, this is another additional cost. Obviously, you can self-manage your property. There's no saying that you can't do that, and that's completely fine. But what I would say is that legislation in lettings pretty much changes weekly. It can turn into a full-time job, and you really do need to be on top of this legislation, because there are hefty fines to be had if you do not. So that's just something to bear in mind when you're thinking about this additional cost, whether it does weigh up the time that you're spending and kind of the headache that it might cause you. And then finally, we go on to net yields. So there are two types of yields. There's a gross yield and a net yield. I've put net yields because I believe this one to be the most important. So net yields is basically the yield that you get after all costs are taken out. So I think this is the most important, because if your gross yield is very high, it looks very attractive, but the costs associated are so high that it eats into that yield and the profit left at the end is quite low, then it's almost, what is the point of investing in that property? Unless you're just investing purely for capital growth, you do just want to be making sure you're looking at the net yields as the most important yields. So how do you work your yields out? So you want to be looking at the net annual income, so the amount of income that you receive every year minus the costs every year. And then you want to divide this by the property purchase price, the price that you paid, and that will bring out your net yields. Now, dependent on the area, your yields will differ. Obviously, the lower priced property, the higher the yield generally. When you kind of look more to the south, the yields are around 3%, sometimes lower, sometimes a little bit higher. But when you go to the north, you can see yields kind of 6% and higher. So yeah, location plays a really big part in the yields that you can achieve. And this also ties in with the capital growth. We have seen that London's capital growth has kind of exploded, and a lot of people will take that lower yield because they are investing more for capital growth. But like I said, in the north, it is a higher yield and you get that cash flow. And the north is also having a lot of investment at the moment. They're trying to kind of balance that south-north divide, and capital growth is something to look out for there also. What I can also compare to, just going back to the West Brom example, is in commuter towns you can get a higher yield also. So in West Brom, we're looking at around 6% net yield. However, when you look into the centre of Birmingham, the yields are more like 3.5 to around 4.5%. So even though it is kind of both in a similar area, you know, West Brom's only 14 minutes away, those net yields can vary considerably. And that's why at ERE we are looking a lot at commuter towns as well as the cities that we normally look at. So now you've done the numbers and the numbers will stack up okay, you want to be looking at the developer. So this is specific to off-plan apartments, so apartments that aren't already built yet. And you want to know who is the developer that is building your development. What's their previous experience? Can you have a look at their track record? Do they have a schedule of works for the build so you can see whether it is progressing nicely? And is it funded or partly funded? So every development is different, so you will need to look into each one. Some developers will put in all of their own money and it is fully funded that way. Some developers will have fully funds from the bank, so it's completely fully funded there, and some will be partly funded. So it might be that the developer needs to reach a certain milestone before the bank then fund the rest of it. So this is just something that you want to be looking out for. You also want to be looking at the planning permission and land ownership. So it would be slightly concerning if anyone was asking for money before the planning permission had been approved. So you can look at this online. We also do our due diligence on this and we can send it over to you. You'll have a planning number there. And also the land ownership, checking the titles and that the developer does own the land that he's building on. Sorry, just also back to the developer on the credit checks. This is an additional step that we take at ERE Property. So we look at the rating of the developer, when the company was formed, the directors of the developer, and past and current companies that the developer has. We also look for any CCJs, counter court judgments on the account, and we actually do all of this for the construction company also, because if everything is all good on this side for the construction company, then we can feel confident that there are going to be no kind of major delays on the development, and that's obviously a positive thing. So then we go on to deposit protection. So with all developments, there will be a non-refundable reservation fee. This is just to secure the property and just know that the developer has confidence in you that you are going to go through with the purchase. So the due diligence should be done before you put any reservation fee down. So all the due diligence I've mentioned in the previous slides should be done before handing over any sort of money, any reservation fee. Then you go on to the deposit. and this can also be known as an exchange amount. So some deposits are around 10%, sometimes they are lower, it's quite rare, but it generally ranges from 10% up to about 30%, and some again can go higher than that. So generally speaking, off-plan properties will have a build warranty in place, and this will protect 10% of your deposit. Above 10%, the deposit can be held in many different forms. For example, the remainder could be in an escrow account, which means it's held with the solicitors, and it might be that it can't be drawn down upon until the build is complete. However, it could also be in an escrow account, and it could be drawn down upon in stages. You also have it where you could be held as a stakeholder. So if it was that the development unfortunately didn't get built, which of course is rare, but it can happen with off-plan properties, it would mean that you own part of the land that the development sits on. And it would be hoped that another developer would come in and finish off the build. So when you're looking at the deposit protection, you just want to be really clear on this. And this is part of our due diligence, that we are really thorough in, and we make sure that we fully understand how your deposit is protected, so we can let you know this when we're telling you about our opportunities. It does all come down to knowing the developer, kind of where the economy is at, and it is that kind of risk reward with an off-plan property. It is seen as slightly more risky, which can be mitigated with this deposit protection, but the rewards of off-plan property and buying a property generally 2 years before it's built is a higher reward than an already built property, generally speaking. So of course, your solicitor at this point will go into a lot more detail. They'll go through all the legalities with a fine-tooth comb, and that is kind of their job, to make sure that the development that you're progressing with is a sound investment for you. So that's me all done for this property due diligence webinar. I really hope that you have got something from it. You've been writing notes and everything, and you have definitely learned something from it. My details are at the bottom there. If you did want to contact me, I'd be more than happy to help you. Any questions you have, just fire them over and I'll be happy to help. This recording is going to be going on our YouTube channel, and we have also written a blog on our website that you can refer to. And this kind of breaks down everything that I was saying in a written form. So if you didn't write any notes, you can take this away. So like I said, I really hope you enjoyed this, and we hope to see you at our next webinar, and they happen every month. So just sign up online and keep an eye out for those. Thank you very much. Bye.